Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Pavitra Parekh. Pavitra, there is no sign of nervousness ahead of this big event. Look at the way the Indian markets have rallied. We're up about 1.4% on the benchmark indices. The Nifty higher by 250 points. The Sensex has gained close to about 800 points. And it's a broad-based rally that you are seeing. Just take a look at the individual indices. The Nifty Metal Index is a gain of more than 2%. Nifty Auto up 2%. The Nifty IT Index has rebounded after last week's big losses. That's got a gain of close to about 1.9%. The banking stocks are providing, some strength today. The Nifty Bank is up 1.5%. The advanced decline ratio nearly has 5 stocks in the green for 1 in the red. So there is no sign of nervousness. I think if you just take a look at the Nifty 50 stocks, there is just one stock which is currently in the red, and that is Grasim, and that too by a very minor cut of close to about 0.25%. So across the board, this is clearly a very, very green screen. Hi.
It's a very green screen. I was trying to count the number of times you said up in that one chat, but it's been wild, right? I mean, you expect normally ahead of this kind of event
There'll be some nervousness,
someone maybe you'll pause, you'll wait and watch. That's what Asia was looking like at, earlier at the start of the trading session, but even that has moved up. Take a look at the Hang Seng markets, up over 230 points. Taiwan is seeing gains of over 120 points. So across the board, you're seeing this kind of, positive momentum play out. Of course, it is the FOMC meet, which we're watching closely. It's going to start later today. And then for us, the decision and the reaction will really come in on Thursday morning. So we'll watch out for that. Today, what is doing well? You have the auto pack, metals, and the real estate sector. All of the sectoral indices are in the green, but these are the ones which are just showing the maximum strength. So some of the top auto gainers on your screen. The real estate pack also doing very well. So something like a DLF, India Bulls Real Estate, all of these faring well in trade. And of course, the IT stocks also this week, they're looking quite good. They are sort of trying to catch up. In fact, look at the gains in the mid-cap IT space today. So something like an Emphasis is up almost 4%. That is the kind of move that you're seeing. So all in all, a very green screen. We're going to keep coming back to this. But first up, let me run you through everything that we have lined up for you on the show today. The market bails on gains after a gap up start. Autos and Realty as well as metals fire up. The mid-caps outperform. We'll discuss the way forward for the market with Sunil Subramaniam, MD and CEO of Sundaram Mutual Fund.
From the sidelines of the JP Morgan India Investor Summit, we'll be joined by the head of their currency, commodity and emerging markets research on the show.
We will also be joined by Samir Bhise of JM Financial as we put the spotlight on the banking sector and discuss the way forward.
News flow drives moves in stocks like Canfin Homes, Natco, Krishna Institute of Medical Sciences, Kim's and SBI Cards. We'll get you all the action on the show. All this and much more in the next 60 minutes on Trading Hour.
All right, so we have a packed show and we're going to be getting to all of those stories in just a bit. But as we start, here's some important opinion. This comes in from James Sullivan of JP Morgan from the sidelines of the JP Morgan Investor Summit. So let's listen into what he has to say from the Fed ahead of the key decision this week.
So we do think the strength of the domestic economy is justifiably driving sector-level outperformance, particularly if the forecast is more of a global economic slowdown. At JP Morgan, we're forecasting the Fed rate to hit 4.5% next year, which is in line with the most recent Fed dots. We're expecting 75 basis points this week. One of the things that we're now starting to see developed market central banks respond to, and we think India will be at pace with this, with a 50 basis point increase rather than the 35 basis point rate increase that we had penciled in India, is the fact that the Fed aggressiveness is leading to very significant dollar strength globally. If I look at what a corporate would spend to borrow money in India, depending on the corporate, you're looking at somewhere between 12 to 14%. And overall loan growth is averaging around 11% in the Indian economy. In China right now, the average corporate would borrow somewhere between 4 to 5%, and loan growth is almost the exact same level and falling significantly. China loan growth is down roughly 30% on a year-on-year basis. India is almost doubled, despite the fact that you're spending three times as much to borrow that money. It definitely creates the opportunity for valuation overreach, and that's something that we're watching very carefully. And one of our arguments, not shocking for a bottoms-up equity person to say this, but one of our arguments is that sector and stock selection is absolutely critical in this overall conversation. And I think one of the ways that we'll see investors make significant outsized returns this year is correctly understanding the sector rotation that we expect to see.
Okay, that's the big global event that we're watching out for very closely. But Pavitra, the expectations are so high that even if the Fed does a 75 basis points rate hike, right, not 100 basis points, as some people in the street believe, inflationary expectations are so high. Look at the way the bond yield has risen to levels of 3.5%, the highest since 2011. The markets will start worrying about a major rate hike in November, right? I think till the inflation numbers really get anchored in, the street is constantly going to be worried about, is the next big one coming in the next hike? And I think that's going to be the fear, the overarching fear.
Even when we got the CPI figure, we were always talking about, we know it's going to be 75 this point, at this meeting. It's about what is going to be after that, right? And of course,
that's what I'm saying. So even if in this meeting we get a 75 basis points rate hike, but the street will start worrying about November then, right? In November, then are we going to get a similar 75 basis points? What's the terminal rate going to be? But of course, this is what's top of mind for all investors. But let me quickly go across to Manisha now. She's standing by. Manisha, what's happening in your world?
Well, it's all topsy-turvy as well. The huge expectations. I mean, as you said, 75 basis points is something that has been factored in by the market already. We have seen that sell-off come in case of gold prices, where we're just about holding at around those 29-month lows right now. But take a look at the currency markets as well. And, just to prove a point here, if you look at the last 1 month, the emerging market equities have declined by 3%. But when you look at the overall commodities index, we have seen a decline of less than 0.5%. So commodities still performing better. And when you look at this year itself, the equities have declined by 20%. This is emerging market equities, but the commodities have given you a return of nearly 20%. Well, yes, there are pain points when you look at the overall currency markets itself, with the dollar index in the positive on a monthly, weekly, yearly basis. Emerging market currencies actually are trading into the negative there right now. Within commodities as well, what has done slightly better has been the precious metals. Even with the gold declining, the decline has been less than what you have seen in various other commodities and equities as well.
Okay, Manisha, do stay on. We'll slip into a very short break because on the other side, we'll talk more about commodities and currency. We've got a special guest from JP Morgan joining in from their Investor Summit as well.
Welcome back. You're still tuned into Trading Hour. The market is only moving higher. It's now over 250 points in the green for the Nifty, and the Midcap index is over 600 points. It is the banks also which are showing a lot of strength today, so that index will come up for you. Of course, this is a theme that we've seen repeat over and over again, but today it's up over 600 points on the Nifty bank. So let's now bring you some interesting opinion. This came in from Hiren Ved, CEO, Director and CIO at Alchemy Capital Management, and he says that the market is heading much higher, and he gives all of his earnings and sectoral outlook as well. So let's listen into that.
We continue to remain very, very constructive on the market. We've thrown everything at this market, right, for the last 12 months, right from rising rates to inflation, to the Ukraine war, to the energy crisis in Europe. And despite that, if the market's just shy of its all-time highs, it's telling you something, that this is more structural. India is in a great position, despite all the challenges that we are seeing around the world. And I have no doubt that our markets structurally are heading to much higher levels than where they are today. Okay. The resilience has been great. Having said that, in the short run, what we've seen in the past is that usually if there is a deep cut globally, then a catch-up happens. But I think in the medium to long term, I still believe that Indian markets will decouple from the global markets, because I think we are in a very different situation and stage. Unlike in the past cycles where our macro was very, very challenged and FI flows were the predominant flows in the Indian markets. Today, you now have a very robust domestic liquidity which is consistently going into the market. We typically tend to bottom out at somewhere between 1.5% to 2% of GDP. But once we bottom out and earnings start to improve, that ratio goes up 3x from where you were at the bottom, right? So you were at 2% in March 20. You're now at 4% in 2 years. And the previous peak we saw was in 2007-8 when we went to about 7.5% of GDP. More likely the next peak will be higher than the previous peak because that's what's happened in the last few cycles. But even for argument's sake, if you take 7 as a number and you say we will achieve that 3 years down the line, and then you work backwards, you will see that earnings will grow at 20% plus.
Earnings to grow at 20% plus. But let's get back to individual stocks. Natco Pharma and Kim's are in focus today. Ekta's here with the details. Ekta.
Well, yes, I'll start with Natco, which is in focus because they have received the Delhi High Court nod to basically launch an insecticide, CTPR, in the Indian markets. Now, CTPR, this particular insecticide, gives you an indication that the company is now also making its foray into the agrochemical segment, something that they had decided around 1.5 to 2 years ago. Now, remember that Natco basically was engaged in a legal battle when it came to CTPR. There was basically a process patent which Natco was sued for. Natco had indicated to the court that the company has a non-infringing process, and now the Delhi High Court has ruled in favor of Natco, and hence they can launch the drug or rather the insecticide in the Indian market. Now, this is definitely a positive development because the current market size of CTPR in India is expected to be around 2,000 odd crores. The company plans to launch this product shortly. As of FY22, remember, agrochemicals was less than 1% of sales. Going forward, CTPR could be more than 10% of their whole agrochemical business. Also, on a larger scale, it talks about Natco's strategy as a company, which is basically to look at the jackpot product. So when it comes to the formulation segment, it looked at Revlimid generic within the cancer segment in the US markets, and now it's CTPR within the insecticide space. Now, Kim's is also in focus because there's a further stake sale by General Atlantic. They sold around 12.1 lakh shares. The buyer is expected to be ICICI Pru Life Insurance.
All right, Ekta, thanks a lot for getting us all of that action on Natco Pharma as well as Kim's, both of those stocks trading higher. We'll get into a short break here, but when we come back, we will be joined by Louis Oganez, Head of Currencies, Commodities and Emerging Markets Research at JP Morgan. So stay tuned for that.
Welcome back from the sidelines of the JP Morgan India Investor Summit. We're now joined by Louis Oganez, the Head of Currency, Commodities and Emerging Markets Research at JP Morgan. Louis, thank you very much for joining in. My first question is on the big event, right? FOMC, the Federal Reserve has already said it's going to be higher for longer. What does this mean from a currency point of view? The dollar index is still hovering around 110, and even from bond yields, because we are at the highest level since 2011.
Thanks, Manisha. Thanks, Manisha, for having me. Well, the prospects of more Fed hikes means that the dollar strength that we have seen so far is probably not going to end anytime soon. At some point, reserve currencies do tend to, mean revert, but at this stage, we don't see any trigger for the dollar to start weakening on a sustained basis. So the dollar strength that we have seen so far this year, that is accumulating now in nominal effective exchange rate terms to like a 5-decade high, probably is going to stay around these levels for some time, certainly until we don't have clarity how much more the Fed will need to hike. And given the inflation dynamics, that is still an open question.
Louis, when you say that you expect the dollar index to stay higher, I mean, are we looking at levels like 111, 113? I mean, that is what the street seems to be talking about now.
Well, it is certainly possible. When you look at the, just looking at pair-wise, various components, we're expecting 95 for euro dollar. We're looking at, 147, potentially all the way to 150 for dollar yen. We're looking at 110 for sterling to the dollar. And EMFX, obviously, on the losing end of this situation, and to the extent that it's very difficult when the dollar appreciates against other reserve currencies for EMFX to do well. We're expecting actually the CNY, the Chinese renminbi, to also weaken, go past that 7 threshold, potentially to 710 over the next year. So in that environment, probably we're going to see further gains in the DXY.
All right. So it's not just the U.S. Fed, because we have seen front-loaded tightening elsewhere in the developed markets as well. What does it really mean for the emerging market central banks? Do you see more vigilance? Do you see more action here?
Yes, I think that central banks around the world are certainly, well, on the developed market central bank side, they are all fast-tracking, front-loading their tightening. Interestingly enough, this week we do have 6 G10 central banks scheduled to have monetary policy meetings, 5 of which are expected to hike, in clips of 50 to 75 basis points. In the case of Swiss, it could even be higher. We don't know. The only one that is missing in action is the Bank of Japan, but certainly there's still quite a strong momentum given the inflation dynamics for them to deliver more. EM central banks have been hiking already for quite some time. It started last year, certainly earlier than DM, but given the inflation dynamics, to the extent that it's not yet peaking everywhere, probably the pressure on them is going to be to continue. Certainly, if the Fed goes on, it is very difficult for EM central banks to stop all of a sudden.
Absolutely. Louis, also, when you look at the China zero-COVID policy, that is impacting the developed markets and the emerging markets as well. How much of a bigger concern do you see that in coming couple of quarters?
Well, certainly something that has been, I would say, one of the key drivers for disappointment with the recovery in China, right? We had a very tough second quarter because, important sector of the Chinese economy that is good, key for manufacturing, was under lockdown because of the Omicron variant. Certainly, we were expecting a very strong rebound in this third quarter. I would say that the risk are to the downside, and then to continue in the coming quarters ahead. Our economies have already downgraded the second half of the year recovery, and next year we're looking at a growth rate of maybe around 4.5%. But certainly the risks seem to be on the downside, and this is related to Chinese reluctance to abandon this zero tolerance policy towards COVID. Potentially next spring, certainly you don't do this in the winter when there's a risk of more hospitalizations and the like. Maybe next spring you may see some relaxation of some of these measures, but we're not there yet. So I think that for the time being, you're going to have this policy probably conspiring against economic activity in China.
Clearly that. Louis, I was reading the report that you sent across to us, and even as many of the asset classes clearly are in the negative as we look at them YTD basis, but equities have declined more than what commodities have seen. How would you, how would you rate the performance that we've seen between various asset classes?
Well, commodities certainly, in an environment where China decelerates, that is, potentially going to put some dampener in commodities that are linked to, in general, China or the global business cycle. We're talking about base metals, potentially even oil. Certainly in our own projections for oil to still close the year, near 100 and to moderate to the mid to high 90s next year, does informally incorporate the risk of a U.S. recession. But certainly to the extent that the Fed needs to keep going, the probability of recession goes up. So that is probably something that eventually may need to be reflected in commodity prices.
Louis, a couple of things then. One, how do you look at India amidst all of this with what the central banks are doing? How would you rate that performance? And what's your sense, since India is one of those countries where we import a lot of industrial commodities, crude for one, and many other base metals the second, how are you looking at India's chance as we move into the next year?
Well, the situation with India is, one where the central bank obviously has been tightening and probably has more to go, partly because of the inflation dynamics, partly because of what DM central banks, particularly the Fed, is doing, right? So it is very difficult for EM central banks, as I said before, to stop their tightening cycle if the Fed keeps going, because that continues to put pressure on currencies, that continues to put pressure on capital outflows, and the Reserve Bank of India will probably need to respond to that. What has been happening, though, is that the RBI has been intervening in the FX market. So a lot of these dynamics haven't been necessarily reflected in the currency. But at some point, something needs to give. Either they hike more, or they let some of this steam go through the FX market. Certainly, there is ample reserves in this country, so this policy can continue. But if the Fed continues to hike into the winter, spring next year, sake of argument, at some point there will need to be some rethinking here as well, because using so much of reserves becomes a bit of a futile exercise. At some point, probably even to support growth, support export competitiveness, to help narrow the current account deficit, which is bordering 4% of GDP for the full year, you will probably need some weakness in the currency.
And taken. I have one final question on commodities as well, Louis. And what do you see there? The gold and silver prices have continued to decline. The base metal prices, even as they hit near all-time highs in this year, have come off as well. What is your sense on prices and demand here?
Sorry, Manisha, you got cut off. I didn't get your whole question.
I was trying to get you to tell us on what you expect on price front when it comes to metals, precious metals and industrial metals, base metals, that is.
So base metals, certainly because of we're seeing weakness in global manufacturing, we're seeing weakness in or disappointment in the pace of recovery of China. So I think that there is certainly downside risk for base metals. For precious metals, it's an interesting. We're in an interesting moment. Let's focus on gold. Gold, the correlation between gold and the real 10-year yield is in the U.S. is quite close, even though it has been weakening of late. The fact that the Fed is hiking means that the real policy rate in the U.S. is no longer as negative, and this means that there's less need to use gold as a hedge. However, going into next year, the expectation is that at some point the Fed may need to actually push the brakes sufficiently on the U.S. economy to bring inflation lower, and that may also spell a start of a decline in interest rates. At that time, we may see gold once again resuming its upward trend. So our specialists have a forecast for the price of the ounce of gold, of $1,650 for the fourth quarter of this year, but ending up above $1,800 in the fourth quarter of next year.
Okay. Hi, Louis. Good morning. I was listening into the conversation with you and Manisha on the currency space. This is Pavitra. I thought I should throw in one on the cryptocurrency space as well. We've seen a huge crash. Bitcoin is now down over 50% in the past 6 months. Of course, we've seen what's gone down with the Ether prices as well. What is your sense on this entire space, and do you think there's room for a lot more of a fall?
Well, certainly while the Fed continues to tighten, it looks like, some of these, risky assets that relied on cheap money for so long are probably going to continue to suffer. So I don't think that this spells the death of cryptocurrencies. I'm sure that at some point there's going to be, some, that new asset class, is going to find its footing and its demand. Remember that, cryptocurrencies is still largely a bet on the future. No one knows exactly what is going to be the ultimate source of demand for these cryptocurrencies. But I would say that in the coming quarters, while the Fed is still acting, tightening, I think that it's going to be a very tough environment for cryptocurrencies because, again, they were favored as an investment destination because of easy money, cheap money. That is no longer the case.
Yeah, I guess it's in general people just pulling out of risky assets, right? But Louis, thanks a lot for joining us today and taking us through your outlook on the entire currency as well as commodity space. We're going to leave it at that. But with that, we're going to get into a short break now. When we return, we will be joined by Samir Bhise of JM Financial to discuss the way forward for the banking sector. So stay tuned for that conversation.
back. So even as the Nifty is still about a couple of percentage points away from its all-time high levels, the Nifty Bank hit its all-time high levels just last week. Even in fact, as we speak, it's very close to those levels. And today, the Nifty Banking Index is up close to about 1.5%. Recent RBI data also shows that credit growth stands at a 9-year high at 15.5%. And this time, credit growth is fairly broad-based and not limited to a few sectors. JM Financial believes that this growth is likely to be, fairly healthy in FY23, and credit costs are likely to remain under control. Samir Bhise, the banking research analyst at JM Financial, is now joining in to discuss about the sector and the outlook going ahead. Samir, morning, and thanks so much for joining in. First, your thoughts on this credit growth that we're seeing. 15.5% is what the recent RBI data shows. Is this sustainable? What is driving it?
Yeah, hi, good morning. Growth has been largely driven by uptick in working capital utilization. Of course, retail lending has come back as we have moved to more BAU scenario. What has also helped is the fact that energy prices, which probably were looking pretty precarious in first quarter of this year, right now have come off from the highs that was the case earlier. So to that extent, demand impact has not been there. And banks continue to be in very good shape with respect to retail risk appetite. After 2 years of COVID, most of the issues are behind. So the ability to lend and willingness to lend has also gone up, and that is helping the overall credit growth. So we think FY23 should continue to see reasonably strong credit growth after a long period. At the same time, I would want to highlight that as we enter the second half, one will also be observant of how deposit growth shapes up, given that incremental LDR on a 12-month basis have moved to over 100% for the system. So we think that while demand has held up and is likely to remain healthy in second half, we will need to pull up deposit growth as well as a system, which then leads to the question that will deposit rates rise? We are of the camp that deposit rates should start moving up meaningfully in 3Q and 4Q.
What's your estimate of system-wide credit growth for FY23?
We think FY23 should end on a YOY basis at roughly 15 to 16%, primarily driven by greater working capital utilization. Capex is still some time away in our view, while signs are encouraging, though they have been there for some time. We have not seen a meaningful Capex cycle as an economy for the longest period of time. Though given the low leverage in the corporate sector, it is only natural to expect that they would want to expand capacities, given if some of these macro issues kind of stabilize or one has greater confidence on demand sustainability. So not so much of a FY23 story, probably towards second half of FY24, where you can see some bit of help coming from improving corporate capex.
All right. Hi, Samir. Good morning, and thanks for joining us. This is Pavitra. So something that we have been talking about is this retail loans really picking up and sort of, adding to the momentum. Do you think this is something that's likely to continue? And what would be your idea of the loan picture going forward?
Yeah, so I think it is sustainable. Mortgages have come back, or in fact, real estate demand continues to be well. Banks are in a strong shape to fund mortgages. At the same time, even on incremental basis, it makes sense for, given that rates have gone up. So mortgages is not as a low ROE product as it was, say, 6 to 12 months back on an incremental basis. We think real estate demand should sustain. That's the house view. Secondly, vehicle loans or auto loans, which were since 2018 had been a bit sluggish, those have also come back. So I think growth should sustain. For almost the frontline names in our coverage, we forecast almost a 20% growth this year on the asset side.
By the way, you could see visuals of Finance Minister Nirmala Sitharaman, who's present at the Global FinTech Conference. So we'll be cutting across to get in the key statements from there. But Samir, back to our conversation. What we've seen of late is that deposit rates have gone up, but lending rates have not gone up in commensurate to the kind of increase that we've seen in deposit rates. Why is that? Is it because the competition on the lending side is too high? And what impact will this have on yields?
No, I think some bit of lending rate increase impact will be seen in 2Q, in 3Q, because lending rates were probably linked to the repo rate hike, while deposit rates are more market driven. So almost all floating rate product, especially mortgages and some of the external benchmark linked products, they were a bit too late to react, but now I think the increase is more than commensurate. Incrementally, we expect deposit rates to go up further in second half. Banks should be in a good shape to manage margins, especially in the current quarter as well. Given that if you see from the lows, repo rate is of 140 basis points. Large part of the move has come after June. So all of that will translate into your asset yields. Some bit of liquidity tightness is there, which is probably leading to a spike in short-term rates. But term deposit rates, we think, still have some room to go up, and that is needed for deposit growth to improve for the system as a whole.
All right, Samir, just one final question before we let you go. Within the banking space, is it the larger, blue chip banks that you like, or is it some of the mid-cap names? And also just take us through your top picks in this sector.
Yeah, we have been liking larger names, though some of the smaller names have seen a good participation in the recent rally, and they still trade at reasonably inexpensive valuation. Our top picks among large caps continue to be ICICI, Axis, and IndusInd. Within NBFCs, we like Bajaj Finance as our preferred pick. So these are the top names. Amongst the smaller names, probably one of the new age NBFCs we have recently initiated is Poonawalla FinCorp. So these are our preferred plays.
Okay, thank you very much, Samir, for your time and insight this morning. Let's also quickly get in a few technical trading ideas. Markets still holding on to all their gains, up 1.4%. Mitesh Thakkar is now with us. Mitesh, at 11:30, is there a trade that you would recommend on the index?
Yeah. See, on the index, no, because 17,850 was the target area which I was looking at in the morning. It's been hit. And now I'm not sure whether we'll see an immediate continuation on the upside or whether we'll give a pullback first. So maybe wait out on the index. The bank Nifty, I think, between the two, once it gets past 41,550, 600, and we've had a high of around 41,572. I think once that breakout takes place, then the bank Nifty will be into a fresh, at least on the hourly closing chart, will be in a fresh pivot. So I think, that could at least be attempted on the long side. So buy above 41,600 with the stop at 41,400 for targets of around 42,000.
All right, and Mitesh, what about some individual stock picks? Any recommendations?
Yeah. Sun Pharma, in fact, a lot of pharma names are buzzing today. Sun Pharma is what I've picked up. The good reversal happening over here on the intraday chart. So buy with a stop at about 880 for targets of 920. And the other one is Page Industries, which after a few days of consolidation is showing good traction. That's a buy as well. Keep the stop below 49,400 here and a target of 52,000 on the upside.
Thank you very much for that. Finance Minister Nirmala Sitharaman is now addressing the Global FinTech Conference. Let's listen in.
Gas has become more expensive, and not just for India, for every country in the world, that many countries are going back to coal. India also will have to get back to coal at least somewhat, so that we are able to keep the base level of our energy requirement sustained. So it's sustaining a base level of energy requirement, slightly different from the sustainability debate. But I would like to confine myself to sustainable financial world. Creating a sustainable financial world is what you want me to speak on. I'm talking less, therefore, on global, green, and inclusive. Inclusive, yes, global and green, as I said, is a vast area. And I'd like to definitely talk on it, but some other time. Now I focus only on creating a sustainable financial world. India started this financial world, which is going to be all-inclusive, and at the same time, depending a lot more on sustainable ways of doing it. So the first thing on that is, we have led the way in bringing an inclusive financial world by making sure that financial services will be accessed through the India stack, and that itself for 4 different layers. It's a very good approach to look at financial world by making sure that financial services will be accessed through the India stack, and that itself for 4 different layers. It's a very good approach to look at financial inclusion on the through the route of how many people have got covered, how many poor have got covered, what's the kind of amount which flows to their accounts through DBT, how many have kept a good reasonable balance so that their credit scores go up, and so on. But I also want to bring you this dimension whereby we say the inclusive nature of financial inclusion program of the government is very well established at various different levels. The levels which are being covered here are one at the presence-less layer. The person need not be present. His identity is established. He can definitely be recognized for what he is, that unique human being, unique individual for whom the service is being restored or services being extended. So you find the presence-less layer level in which Aadhaar has served our cause. The next one is the paperless layer, which is enabled through, again, an Aadhaar, eKYC, e-sign, and also the digi-locker level.
All right, that was the finance minister discussing India's, targets as far as creating an inclusive financial world. So some important comments coming through over there. But we're going to get into a short break now. When we come back, we'll discuss the way forward for the markets. Sunil Subramaniam, MD and CEO of Sundaram Mutual Fund, will be with us.
You are watching CNBC-TV18. With us right now is the Managing Director and CEO of the Mahindra Group, Mr. Anish Shah. Mr. Shah, thank you very much for joining us. You have been focusing a lot on your growth gems. Let me start by asking about Mahindra Susten. Ontario Teachers is set to acquire 30% stake for 2,371 crores. What was the strategy and what are these proceeds likely to be prioritized for?
So good morning, Parikshit. Great to be here with you today. This is actually a very exciting step forward for us. Ontario Teachers is one of the most respected pension funds around the world. They will bring a wealth of knowledge in renewables that will help us build this business. The objectives for us were to really establish Susten as one of the top players in renewables in India. There is huge market opportunity. Our Prime Minister has also talked about renewables being 50% of energy production by 2030, and therefore we feel that Susten is very well positioned in this space. It does require capital, and in the context of our capital allocation approach, we have talked about growing growth gems, but also partnering with large marquee global investors in doing so. And therefore this is one where it meets the objective of us partnering with a marquee investor, helping us grow the business further, and allowing the capital to come in, which then puts us on a faster path of growth and better returns. So it's a combination of all of those things.
Any key projects that you would like to focus on in the near term when it comes to Mahindra Susten?
So there are multiple projects that we will bid for, as we have been bidding. Susten actually is a business today which did both EPC as well as development. We've done more than 5 gigawatt, and the plan is to really take this at a different level. We've typically been bidding on a large number of projects, and that will continue.
Right. Just to also ask you about plans for other IPOs. In November 2021, you had said that in 2 years you'll come out with the next IPO. Have you identified any of your growth gems for an IPO, for a listing?
Yes. So to clarify first, 2 to 4 years, we've been very careful about what we commit and make sure we deliver what we commit. We are on track for multiple businesses to be on a very good growth path as part of our growth gems. And there are 2 or 3 businesses that we will look at bringing to IPO in that time period. But there's a little more work that needs to be done to make sure that they're really strong businesses when they come to the public markets.
Right. Would you like to tell us about those 4 businesses?
Not at this time, but we'll come back with more details on that.
Okay. Now, there have been a lot of reports about Mahindra Group looking to separate its automotive business into 3 parts. Will the EV, tractor and passenger vehicle businesses become standalone entities in order to unlock value?
So at this stage, the step we've taken with the EV co being separate is really the primary step. There are no plans in the short or medium term to look at any further separations as such. And we believe that with the new EV company that we are setting up with an investment from British International Investments, will really be a company that takes electric to the next level.
Right. Is Pininfarina likely to be clubbed with the EV project, with the EV company?
At this stage, we're not looking at clubbing Pininfarina with it. I think Pininfarina operates in a very different market with a different segment, and it does well at what it does.
Right. Just to ask about deploying additional capacity. When we spoke to you on the 15th of August, you said that your immediate priority would be to deploy additional capacity for the Scorpio, for the XUV700 and the Thar. What about acquiring the Talegaon plant? Mahindra Group was in initial talks with General Motors. Where have things reached?
So we continue to be in talks there as well as look at various options. For us, capacity creation is not as much about the plant. Our Truckan plant has the ability to expand and be able to put in more lines. It's about getting the entire supply base ready to be able to generate a lot more capacity for us. We're not looking at a 20-30% capacity increase. We're looking at far greater than that. And plans are set. Things are underway at this point. We will be sharing it publicly once we have some of the uncertainties taken out.
But this is at existing plants.
Existing plants have lines. So as I said, expanding capacity is not an issue with our existing plants. Expanding capacity has to be done in conjunction with all the suppliers. They have got to put in extra lines. They've got to put in investments, get the machining tools in. So once all of that happens, that allows us to take capacity to the next level.
But either acquiring Talegaon or Ford's plant in Tamil Nadu, that remains on the table as an option?
So it's not essential for us to acquire plants to do this at this point. So while we will continue looking at various options, that's not the gating factor for capacity expansion for us. That's more a longer term plan. Because we will need, beyond the set of capacity that we need right now, we will need more capacity for our EVs once it comes in.
All right.
So those are longer term options beyond that. At this point in time, our capacity expansion is not contingent on acquiring any plants.
Okay. How geared up are you for the festive season production? What is the current capacity utilization?
100%. We have huge demand, as you know, across all our models, and therefore our capacity is fully utilized. And we are expanding capacity. We may have some of that in the next few months, but then more in a few months beyond that.
Will this demand sustain itself beyond the festive season?
At this stage, if you look at the XUV700, we've been getting 10 to 11,000 bookings for the last year. So it's one that is really driven by the product. Similar with the Scorpio N, we had, as you know, 1 lakh bookings in the first 30 minutes, and there continues to be very high demand for that, which again is driven by the product. So is it with the Thar, with the XUV300. So we don't see this demand going down. In fact, as we put in more capacity, we would likely see it going up because we can serve the capacity or we can serve the demand faster. Today, the challenge we have and the one thing that we are unhappy about is we can't meet customer demand as quickly as we'd like to. That's what we need to address.
Right. The pressure of high raw material costs, especially steel, iron ore, rubber, there has been some cooling off in prices. Do you think things are coming under control? The prices are stabilizing, commodity prices are stabilizing, or would there be more price hikes in the offing in the coming few months?
We have seen some stability on that front, though we do continue to be concerned with the inflation worries around the world, because India is not going to be left out of that. We also feel that the government actually has taken a number of proactive steps, and which is why we see a greater level of stability in India today.
I'd also like to ask you about your continuous focus on cost efficiencies amid this challenging global economic environment. Where do you think India is with regard to inflation? Is this the peak, or you think that things could get worse in the days to come? What are the major headwinds that you see for the Indian economy?
So India is today positioned much better than the rest of the world. The increase in inflation in India is 150 to 200 basis points as compared to a much higher increase we see in many of the developed markets. That has been a factor of proactive actions, both in terms of rate hikes by the RBI, in terms of addressing some of the input costs by a variety of measures. And based on that, we do feel that that stability will likely remain unless we see much greater inflation around the world. We also see the US Fed and various other central banks focused on this as a huge topic. We will likely see higher rates in many countries. And if that's done aggressively, that will help keep the world in control, which will help India. The other factor here is crude oil prices. And if you look at oil prices, they have gone up, they've stabilized again to some extent. But that's going to be a key factor in driving where India goes as well.
Right. My final set of questions, which are some of your other businesses which are likely to post strong growth? What about Mahindra Logistics, Mahindra Holidays? Any other areas, any other sectors where you expect the companies to deliver strong growth in this fiscal?
So today, we have all our businesses firing on all cylinders. So if we look at auto, we talked about that great momentum. Our farm business continues to do very well with growth drivers in farm machinery and global as well. Mahindra Finance is on a very strong recovery path. Tech Mahindra is taking advantage of many of the tailwinds behind it and addressing some of the issues around margin that we need to address there. Holidays, life spaces, logistics, all doing very well. Life spaces business actually hit $1 billion of market cap just a couple of weeks ago. So one of our first growth gems to hit that mark. And many of our other growth gems will be hitting that mark in the next 2 to 4 years.
So maybe Mahindra Life Spaces would be the first for an IPO.
Life Spaces is public actually.
Public actually.
So some of the unlisted entities will come up for IPO as well.
Yeah.
But we wanted to get 3 of our public entities, Life Spaces, Logistics and Holidays, also to the 1 billion mark. So we've started on that journey.
Okay. And my final question on electric vehicles. You recently launched the XUV E400. What has been the response in terms of bookings? And we've also seen Tata Motors now announcing an affordable EV, which would be less than 13 lakhs. Is that something that Mahindra would also consider, maybe an affordable EV as a next option? Or would you go with the roadmap of the 5-6 cars that you've showcased?
So the response we've got is fantastic so far. We haven't started bookings as yet. So once we start booking, we'll see. But the XUV 400 is best in class in a very large number of areas.
Right.
So we do expect that to really garner a fair degree of demand.
All right. Thank you very much for speaking to us, Mr. Shah.
Okay, that is M&M talking about a whole host of issues where they want to scale up the Mahindra Life Spaces business, $1 billion in terms of valuation, how they geared up for the festive season as well. Interesting conversation, but we need to get into a break. We'll come back with more on the markets. Welcome back. Nudging towards a 2% rally now on the mid-cap. And look at the way these stocks are moving. Metro Brands, we had a chat with the management earlier. They're committed to opening 200 stores in the next 3 years. Also confident about e-commerce and the way it's been growing. That stock has surged close to about 9.5% in trade. Apart from that, you've got Bombay Dyeing, which has gained ahead of its board meeting on the 22nd of this month. So that's later this week, where they will consider a fundraise via the rights issue. The stock is up close to about 6%. A couple of the other movers include Mahindra Holidays, VIP Clothing. So a lot of travel and tourism. With that, we're out of time on Trading Hour from the entire team. Thank you for watching.